That 1,500% returns over 2 years are now off the table for Tesla. I would agree with that. But I do believe that ultimately this can be a $2,500 stock. The results that they just put up for September were nothing short of spectacular.
Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So, as you guys heard in the intro there, Gene Munster, a fairly conservative stock analyst, believes that Tesla stock will triple to $2,500 per share, and in his own words, Tesla's Q3 delivery results were spectacular. In this video, I'll be reacting to some comments from Gene discussing Tesla, the stock, and more. So let's get into the video. If you love crypto, stocks, and free stuff, or just want to help out the channel, check out these great offers. BlockFi are launching the world's first Bitcoin rewards credit card. People in the US can earn 1.5% Bitcoin back on every purchase with no annual fee using the BlockFi Bitcoin rewards credit card. Check out the link in the description. And for a limited time, you can get up to $250 in crypto bonuses when funding a new account on BlockFi, where you can use cryptocurrency to earn interest, borrow cash, and buy or sell crypto. If you want your free crypto, use the link in the description. And if you'd like up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $300 just for opening an account. And if you make an initial deposit of $5 or more, you'll get a second free stock valued up to $2,000. Seriously. Free stocks? Yes, please. And finally, if you're in Australia, the UK, or New Zealand, you can get a free stock with stake, also linked in the description. Thanks so much for your support, guys. Let's get back to it.
Martin, for the first question is, are they missing anything? And I harken back to something that I learned when I started on Wall Street many years ago, that you do not go broke taking money off the table.
Now, this is a fair point, absolutely true. You won't go broke taking profits, taking money off the table, but I have a counterpoint. I also don't believe you will get wealthy taking money off the table. Now, let me explain why. And just for the record, I think if you're somebody who's driven by their emotions and or doesn't have a strong investment thesis, doesn't have a huge amount of clarity around why you own a stock or another asset in the first place, you have a lot of uncertainty about the future, you won't be able to sleep well at night, no harm in taking some money off the table. However, if you're not, how should we say, confused and scared about your investment, I'm of the rather controversial opinion that it's worth taking the colossal risk of not taking profits off the table if you strongly believe that there's a lot of growth left in said asset. Now, of course, you could be dead fucking wrong, in which case, rip you, but then again, if you don't know what the fuck you're doing, why are you investing in this asset in the first place? And yes, there could be some terribly bad luck along the way as well, in which case you get completely fucked and could do nothing about it. This is why I also believe it's important to have a strong financial foundation. I don't just own stocks, I also have real estate that I began purchasing more than a decade ago. I have business assets producing recurring income while I sleep. I've got this YouTube channel, and more important than that, I've got a lot of skills and experience that can add immense value to the marketplace. So even if everything disappeared tomorrow, I could rebuild, earn a pretty considerable income, and redeploy that capital. So just to be clear, I'm not advocating being a complete and utter moron. However, as I said earlier, you're not going to get wealthy taking profits. Now let me explain why. Maybe you've heard of this thing called capital gains tax. Now, these rates vary, different parts of the world have different rates. Some don't even have capital gains tax. But just for example's sake, I'm going to assume, like me, you live in one of the parts of the world where you have a relatively high capital gains tax rate. So if I buy a stock tomorrow and then I make a $1 million profit and then sell, guess how much I have to pay in capital gains tax? Are you ready? 50%. So I certainly won't go broke taking a profit. Then again, neither will the government, who gets half. Time for a visual example. We're looking at Apple stock. Now, show me where on this graph an investor would be glad that they took some profits, locked in some of their gains, took some money off the table. After a 200, 300, 400, 500+% rise in Apple stock, hold it for almost 20 years, you've made 2,000%. Great time to lock in some profits, right? Right. And then what happened subsequently? Well, we're now looking at a 15, 16, 17,000% gain. Good time to lock into profits, right? Or maybe at 60,000%, maybe that was a better time to lock in the profits. Or maybe 82,000%, maybe 141,000%. Where on this graph would have been the ideal time to lock in some profits? Maybe at 199, almost 200,000% gain. Or what about a 352,000% gain? Where on this graph was the ideal time to lock in some profits? Assuming, of course, there was no emergencies, you didn't need the capital, etc. Now let's do the same thing with Amazon stock. Maybe it was a great ideal moment, a good opportunity to lock into profits after a 3,800% gain in just 2 years. Sounds pretty good, right? I mean, that's phenomenal, amazing, incredible return. Surely it can't keep going up, right? Let's fast forward a little bit. Oh, no, we're now at 4,000, 7,000, 10,000, 12,000, 21,000, 56,000% gain, 110,000% gain, 186,000% gain. Once again, please show me on this graph where exactly would have been the ideal time to lock in some of those profits. Keeping in mind, you do have to pay your capital gains tax, and so you lose some of those profits anyway. And now we're looking at Tesla, a much more recent and a shorter time scale in terms of this example. So again, same thing. Maybe after an 830%, almost a 10x within the first 3 years. Pretty good return on the stock, by the way. I have a friend actually whose father was big on Tesla, bought the stock and sold somewhere around here. Oh boy. Anyway, moving along. Maybe it was here. Tesla stock languishing, maybe you've got about a 10x return, it's not doing much for the next few years, why don't you sell now? It's in a bit of a lull. Not really, I mean 1500%, that's not that good, who cares, whatever, let's sell, hey? Oh no, Tesla stock's down, I better lock in my 10x profit, right? Well, as we know, that played out a little bit differently. Tesla stock now at a 20,000% return. Once again, I asked the question, when was the ideal time to lock in your profits? In my opinion, instead of locking in some profits, you should instead be paying very close attention to what the company's doing, and more importantly than that, what the future looks like. Do they still have growth ahead of them? How much market share do they have? Is their lead accelerating? Do they still have competitive advantages? Moats? What do their profits look like? How much revenue? Is their revenue growing? Blah, 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 blah. This is where you should be focused rather than, the stock's gone up a lot, I better sell and lock in some profits. But of course, this is just my unhumble opinion. So let's continue this hypothetical scenario. I've just sold. I've paid half my profits to the government. Lucky them, I'm sure they'll spend that money really well. Now I have half as much capital as I had previously deployed in an asset because I've had to pay my capital gains tax. Now, if I want to get an equivalent return to just leaving that money where it was, I will need to get double the return of the asset I could have continued to hold. If that asset was going to 10x over a decade, I would need to redeploy this capital into an asset that goes up 20x in the same period of time just to be even. Now, don't get me wrong, these opportunities do exist. And if you can find this kind of opportunity and the numbers make sense, no problems whatsoever. But this isn't taking money off the table. This isn't locking in a profit. This is finding a new opportunity and pursuing it. However, there may be another way. It's called leverage, debt, accessing some of the value of your assets without actually selling them by borrowing money and paying a minimal interest rate. Now, there's some people out there that seem to have an extremely irrational aversion to debt. I can tell you for a fact, in almost 100% of these cases, there's two core reasons. One, they've been brainwashed by their parents or people close to them that debt's bad, all debt's bad, there's no such thing as good debt, blah, 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 debt's the worst, blah, 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 blah. Or someone very close to them got completely wiped out by using too much leverage, investing recklessly, losing it all because they f***ed up. And yes, there is the third type of person who generally will have a major aversion to debt, although they make up just a tiny fraction of folks, but I should acknowledge them as well. And that is somebody who is extremely anxious, a worrier, the kind of person who will lose sleep over just about everything. By the way, I just really quickly want to address the presumptuous clowns out there who've automatically and incorrectly assumed that I'm talking about using margin to buy stocks. I'm not. So anyway, back to the topic at hand. I just want to give you guys and girls a couple of examples that'll drive my point home. I decided to invest in real estate more than a decade ago. Now I had two options, save up and buy my first property with cash, or borrow money and give a 10 or 20% deposit and get into the market sooner. Now, I did the math on this just hypothetically. Okay, what if houses continue to increase at the rate they have on average over the last few decades? Okay, oh wow, I can't even save fast enough. I'll never be able to buy a single property. I literally can't do it. Or I can borrow money and then benefit from that appreciation. I chose the option of borrowing, paying a small deposit, and managed to establish a multi-million-dollar property portfolio within the span of just a few years. Now, this clearly included taking on considerable debt, but I just want to point something out here. Every time I purchased a property, I bought under value, I immediately increased the loan against that property to more than it cost me to actually buy and pulled out more money than I put in and just kept that aside in case of emergency. I did this over and over and over. So every time I purchased a property and took on more debt, I actually ended up with more money available to me in case of emergency. I did all the math and thought, wow, I could survive for about a decade based on the amount of cash I've pulled out, even in the worst case scenario. So the more debt that I had, the safer, the stronger, the sturdier a financial position I found myself in. I still own all of that property, and guess what? Every time I feel like it, I get them valued, valuer goes out there, or an automatic computer valuation is done, and I have the ability to increase the loans against those properties across the board back up to 80% of the value and release a huge pile of cash. At this point in time, I've got about $250,000 available to me should I choose to unlock it and pull it out. Now, I know there's going to be a few people ready to warn me in the comments that Australian real estate's in a bubble, that property prices are going to crash here. 1, please stop listening to Harry Dent. 2, you obviously, evident by your comments and your thoughts and your attempt to warn me, have no idea what you're talking about. And 3, please set a reminder to check back in 10, 20, 30, 40 and 50 years for real estate growth, capital growth in both Sydney and Queensland. Enough said. It's like those DMs I began getting almost 2 years ago of people warning me Tesla stock was going to crash. What can I say? I do my homework. Now, I'm not sure about you guys and girls, but personally, I'd much rather borrow against my assets, taking a loan and paying just a few % interest than losing half of the profits by selling those assets and never being able to benefit from any future appreciation. But hey, you do you. And now, just a final point on this gigantic aside before we get back to Gene Munster and his comments around Tesla stock. I challenge you. Name a single company that's now worth over $100 billion that never in their operational history ever took on any debt and at this point in time doesn't have any debt. I challenge you, I dare you, name one. And just on the odd chance that anyone happens to find a single solitary example, just consider the fact that this is the exception to the rule. Now, there is absolutely nothing wrong with avoiding taking on debt, but I'm just trying to give you guys and girls a little bit of an insight into how useful debt can be in terms of investing. As Gene Munster said, you're certainly not going to go broke taking a profit, nor are you likely to get wealthy. And the same can be true in terms of investing and being scared of using debt. If used correctly and safely, debt is a wonderful tool to accumulate and multiply capital. Typically, what you'll find is most businesses that ultimately grow to enormous scale, generally speaking, are very debt heavy and borrow a lot initially to get the ball rolling and reach scale, and then over time, when they have an abundance of cash flow, then they begin paying down debt over time. This is also the strategy that I'm personally employing for my own investment business. But I admit, I have rather ambitious investment goals. I plan to do a lot of future philanthropy and I need a shit ton of money to do it. There was no other option for me. Avoiding debt means failing to achieve my long-term goals. Not an option.
You highlighted what Tesla has done over the past year. I would add that if we look over a 2-year period, that's up about 1,500%. I think that those major supporters either lightening their load or exiting their position is more just about them managing their wealth, and it's an indication about what Tesla has ahead of it. True that 1,500% returns over 2 years are now off the table for Tesla. I would agree with that. But I do believe that ultimately this can be a $2,500 stock, and we can kind of talk about how we get there. And so a question I would have is, does going from 800 to 2,500 over the next 5 years, it's going to take some time there, but I think the results that they just put up for September were nothing short of spectacular.
So there's a lot to discuss there. Munster, of course, very impressed. Tesla's Q3 delivery and production numbers, quote, spectacular. Can't get much higher praise than that. But more importantly, Gene Munster saying that he believes Tesla stock could be worth $2,500 per share over the next 5 years. Now, in my opinion, Gene Munster has proven himself to be a very conservative and intelligent, but a conservative analyst. He's needed a lot more proof and evidence, results, before he's been able to really go out on a limb. If you look back over the last few years of comments from Gene Munster regarding Tesla stock, and most importantly, their delivery numbers and their financial results, you'll see a recurring theme. Surprise. Oh, wow, they delivered more than we thought. Oh, their margins are better than we thought. Wow, there's more demand than we thought, over and over and over. But to hear Munster talking about Tesla stock being worth $2,500 per share, this is in the ballpark of ARK Invest and myself. Last we heard, ARK Invest base case for Tesla stock in 2025, so not quite 5 years, was $3,000 per share. Munster talking about $2,500 per share in 5 years, so pretty close timing, pretty similar amount, slightly more bearish than ARK Invest, but still in the same ballpark. Just want to remind you folks, my price targets in my bear case for Tesla stock, 2025, $3,500 per share, 2026, $4,200 per share. Now I know this is a little bit higher than Gene Munster. He's at $2,500 per share at the same point in time that I'm at $4,200 per share. But the very fact that we're now in the same ballpark, it's quite surprising to me.
And I think that the thesis that they had invested in is continuing to play out faster, and I think with more substance against the auto industry than probably they ever imagined.
So, TSLA 2,500, 5 years out. We'll talk about, we'll get you to make the case in just a bit. But in the here and now, Gene, unlike, let's say, the legacy automakers, for that matter, some of their EV competitors as well, is Tesla suffering through the same sort of supply chain kinks and having to deal with the chip shortage? Yes, but they seem to be managing pretty darn well. If you take a look at their deliveries, they're still far. I mean, the lead between them and the legacy car makers just continues to be nice and wide. What are they doing that their rivals are not able to get a handle on in terms of this chip shortage?
So let me quick frame in what nice and wide is. I would agree with that language. It's about a 50% faster growth that Tesla has reported over the last 2 years. And the results that they just put up on a few days ago, I think will be representative of that growth. I just want to quick put another point around that, as this would include about 120% year-over-year growth. If you adjust for the comp last quarter, that means that adjusting for the comp, the pace of growth was consistent, above 100% for 2 quarters in a row. Spectacular. So then begs the question of what is going on in this narrative that Tesla is going to somehow lose their ground relative to all this EV competition. There are parts of that which are true, is Tesla is losing market share in EV from virtually 100% share in many countries. But I suspect that they will baseline at a much higher market share than any auto company today. If you look at kind of Volkswagen has about a 15% market share.
So this is a huge comment from Munster. Huge. Let's think about this for a moment. Volkswagen, world's largest automotive manufacturer, approximately 10 million vehicles sold per year, 15% market share. Munster there stating that he believes that Tesla will end up with a larger market share in percentage terms than Volkswagen has today. From this, we can infer that over the long term, Munster expects that Tesla will be selling more than 10 million vehicles per year, or in the case that the global automotive market contracts quite dramatically, they'll still be over 15%. They'll be the biggest automotive manufacturer on planet Earth in the future. In either case, this is hyper bullish. Of course, this shouldn't be news to anyone who's been paying attention. Tesla themselves aiming for 20 plus million electric vehicles at the end of this decade. But it is nice to hear some Wall Street stock analysts starting to talk about Tesla ultimately growing into the world's largest automotive manufacturer. Just a few years ago, comments like this would have had Gene Munster laughed off the air.
And I will answer your question here. What is Tesla doing right? It's pretty simple. They have the best value for an EV right now. It just is, if you look at range and features, this is a clear choice for consumers, and they are voting in the form of purchasing the cars.
An important, albeit an obvious point, but what's more? Tesla is making more money on every EV they sell than anyone else on the planet as well. So behind the scenes, from a business point of view, it's not just they have the most compelling product, therefore consumers are choosing them in droves over anything else in the marketplace. But for every vehicle Tesla sells, they're making way more money than anyone else trying to even compete. This is a pretty impressive situation to find yourself in.
Gene, how is Tesla performing in the China market?
China's been a challenge. And I think in part because there are many automakers, EV automakers, NIO, for example, that have had a ton of success. I think that their share has diminished. And I think it's still an important market that's on the table. I'd be curious to see how deliveries are going to play out in the next few quarters. And I would just put this, if I was in Tesla's shoes, getting China right is probably the biggest lever for upsize. And I think probably one of the biggest reasons why Tesla has not performed maybe as well in China as in other countries is just simply the price of the product relative to some of the competition. It's been harder to compete on that front. Still a long ways to go. I suspect that they're going to be pushing down the price of Model Y and Model 3 in China, which should probably help boost sales in the year to come.
Definitely true. Tesla will continue to drive the cost down of the Model 3 and the Model Y, but far more important than that, the $25,000 Tesla, the Tesla Q, as I'm really hoping it is called. This is the car that is going to sell millions of units in China, millions of units in Europe, millions of units in the US. This is the car that completely destroys the internal combustion engine industry. As we know, there is a China-designed version of this vehicle. Don't know when it's going to be unveiled, but it can't be that far away. Of course, Tesla needs to be strategic. If they unveil this vehicle, then it takes a year and a half to actually come to market. How many people do you think will put off buying a Model 3 or a Model Y because they want to get the $25,000 Tesla instead? So Tesla does need to be mindful of this. But it's not the Model 3 and the Model Y that really matter in China. It's the next generation vehicle. So I hope you guys and girls have enjoyed this video, including the tangent relating to debt and taking profits. And I just want to ask you guys and girls a question before we wrap up. Do you think Gene Munster is starting to become a Tesla hyperbull after all? He's just said he expects Tesla will have the largest market share of the global automotive market in the future, and he's in the same ballpark as Cathie Wood, ARK Invest, and this crazy mofo in terms of his Tesla stock price target. Let me know in the comments below. I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. And don't forget the BlockFi Bitcoin Rewards credit card, where you can earn 1.5% Bitcoin back on every purchase. There's a link in the description. You can also earn up to $250 in crypto bonuses when funding a new account on BlockFi, also linked below. And finally, don't forget your free stocks with WeBull and Stake, also linked in the description. These great offers also help out the channel. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.